Hi, it's Jeff Garber, mortgage expert, and welcome to my Money Foundations video series. And in this video, I'm going to pick up right where I left off from my intro video. And we're going to talk about two things today. One, we're going to talk about the topic that I said, the statement that I said about houses, meaning houses were not meant to store money. They were meant to store people. I'll tell you what I mean by that. And we're going to talk about safety, liquidity, and rate of return when it comes to your money. This is very important. So let's begin. So what do I mean by houses were meant to store people, not money? Well, look, I am definitely going to possibly strike a chord with some of you here, maybe get a little controversial. That's okay, because I always tell my clients, it is always better to see both sides of the coin before you make your decision on your mortgage than find out later that you made a mistake. So I always like to look at both sides of the coin. The first side of the coin is the older rules of money that some people still follow, and that's okay. You just have to know the consequences of it, but that's putting a lot of money down and trying to pay your mortgage off quickly versus possibly doing that a better way. And so it starts with houses. We're meant to store people. That's what they're for. That's why we buy a house. Now think about this for a second. You have money, right? You want your money to grow. And so every dollar that you take and put into the walls of your house earns a 0% rate of return. So to take that to the next level here, if you have $1 and I said to you, hey, put it over here in your house, or get with a financial planner and invest that dollar in something that's going to earn a rate of return and compound from day to day, month to month, year to year, and grow. Which would you rather do? Because if you put it in the walls of your house does not pay you a rate of return. Whether you get, if you were going to buy a $100,000 home, whether you were going to pay cash or get a mortgage for $100,000, that doesn't matter. That doesn't affect the investment, so to speak, from a standpoint of homes appreciating. In other words, your house is going to appreciate or depreciate regardless of whether you have a mortgage on it or not, regardless of whether you paid cash or not. And people buy houses so that the appreciation can grow from year to year, and your home is worth a lot more money than you paid for it when you bought it. And that's a good thing. But think about what we're doing with our money right now. What I mean by taking $1 and putting it into your house, a lot of people say, hey, you know what, I'm going to pay extra on my mortgage each month. And let's just pretend it's $100 a month extra. Right, I'm going to grab my calculator here, but think about that for a second. $100 a month times 12 months, that's $1,200 a year. Right, let's say I do that for 7 years. Right, that's $8,400 on my calculator here of money that I've taken, that I've worked hard for, and I've put it into my house where it earns no rate of return. And get this, right? If I want to get that money out, right, I can only do that one of three ways. Either I have to sell my house, possibly go to a local bank and put a home equity line on it or a home equity loan, or I have to refinance, right? I have to actually pay to get my money that isn't earning a rate of return. So why would I want to leave it there? And get this, let's say something happens in life. Lose your job, become disabled, become sick, family member, husband, wife, spouse, lose job, all right, and you can't pay for that mortgage anymore. And you've put that $8,400 in. And you can't refi, or you can't get a home equity loan because you don't qualify anymore because of the income, right? You now either have to sell and then figure out where you're going to live, or you get foreclosed on if you can't pay your mortgage anymore. And so the strategies I teach, that's where the first S comes in, safety. Right? Is our money safe in our home? Many people feel it is. Many people sleep well at night knowing that they're putting all of this extra money into their home. But we don't realize that it's not safe until life happens. And the examples of life happening was 2008, Great Recession. Many people put a lot of their money into their homes trying to pay mortgages off. Many people lost their jobs. And you can look it up yourself, but the foreclosures were nuts. They were crazy. There were many foreclosures, right? And a lot of these people, if they might have, stored their money, managed their money a little bit differently, managed their equity a little bit differently, well, maybe they wouldn't have got foreclosed on. That's what I try to teach people. Now, am I saying it's bad to try to pay your mortgage off? No, but maybe there's a better way to do it than the way we think is the right way, because life happens. So that's where safety, liquidity, and rate of return come in. So number one, we want to keep our money, especially our equity, that we can control, where it's safe. Now, of course, as your house appreciates and the money is growing in there, you have options with that. But I'm more specifically talking about every dollar that you earn and where that's going each month. Okay? You can pay off your mortgage, but maybe not the traditional way. What if you said, hey, I want to take $100 a month times 12, that's $1,200 a year, and I'm going to use that money, I'm going to call it equity. But I'm not going to put it in my house. I'm not going to pay my mortgage down. I'm going to get with a financial planner who understands this and is going to do something that is suitable for me, because financial planners have to be suitable, meaning they can't take your money and do something that benefits them and not you. And there are many strategies that decent financial planners know of where they can put that money, that it's not something that you're going to risk losing. All right, we're not putting this in high aggressive stocks. This is going to be a much more controlled and less risky portfolio. But the idea is we want to get a rate of return on our money. We want it to be safe, where we can get it, liquid, where we can turn it into cash. We want to get a rate of return on it. And banks know this. I think Einstein said the eighth wonder of the world is compound interest. And everybody's heard about it. But until you really realize how compound interest works, until you stop and think about it, and realize that banks do this to us all day, and they're wealthy because of compound interest, and we're not, because all of our money goes to them, it makes you think a little bit. And you can actually become your own bank. It's called arbitrage. All right. If you put your money in a savings account at a bank that pays you 0.01%, okay, well, what's the bank doing? They're turning around and lending money in savings accounts to other people that need a car loan at what, 3, 4, 5, 6%? They're doing that with your money. All right, so why wouldn't you possibly want to do the same thing? How do you do that? Don't give it to them. Don't give it to the bank. The big banks and the emotional advice that you get that is driven into us is do a 15-year mortgage and put all this money in and pay extra a month because you're going to save all this interest. I mean, why on earth would they be giving you that advice if it doesn't make them money? All right, think about what you're doing. You're taking all of this money, giving it to them, and they're the ones that are making the compound interest on it, when you could be doing the same thing. And this is where the rule of 72 comes in. And that's what I'm going to talk about in my next video. Again, I'm trying to keep these short. Right? The goal of this video is to let you know that houses were meant to store people, not money. And when it comes to your money, you want it to be safe, liquid, and you want to get a rate of return on it. So if this is of interest to you, I look forward to seeing you on the next video where I'm going to share with you a magic formula, the #1 banking rule. It's called the rule of 72. And when you learn this and understand it, possibly will make you think differently about money. Questions, comments, put them below. If you would like to set up a free 15-minute consult with me anytime to discuss this, be happy to do so. Thanks. I look forward to seeing you on the next video.